Howdy Cup to Tan. Hello everyone, welcome to Global Talk. I'm Graham Cunningham, Global Investment Strategist. Today we got two topics. One, we're going to talk about the effect of Brexit on some of the large cap listed companies in the United Kingdom, or lack of effect. And we're also going to talk about one of my favorite valuation metrics, which is the valuation techniques, which is price to book comparing price to book and return on equity. Okay, so we go to the first slide. Here we go. So this week was the beginning of the official process of the United Kingdom exiting the EU. I think this is actually not that big of a deal. One of the biggest issues with a country leaving an economic union is whether they're using the same currency. And as you probably know, the UK has its own currency, the pound. So a lot of the adjustment process is in the currency adjustment process. For example, when you have a country like Greece, in the European Union, where there's always been a question for many years of whether they would leave, there's a big issue of will they have to issue a new currency and how would they value that, and there'll be a lot of dislocation as that shifts. When we saw the UK announce at the middle of last year that they were they had voted to leave the EU, the currency almost instantly adjusted and has been adjusting down ever since. So what you have is like a safety valve if you still have your own currency, where people can price in any of the changes they expect. The markets can just sell off the currency, and that sort of solves the problem. So from that point of view, Brexit's not that much of a big deal. I wanted to look at from an investor's point of view. A lot of our clients are probably looking mainly at the very large cap names in the UK. So maybe look at the top 20 names and then one by one and see, or sector by sector, and see if there's really that much of an effect. If you go to the next slide. So 5 of the top 20 are material stocks. Shell and BP are both oil and gas exploration stocks. And then you have Rio Tinto, Glencore, and BHP, which are materials stocks, basic commodities. And so what you can see is that for certainly those 5, Brexit's not really that much of an issue. There could have been currency issues, but those have already sort of played out. These things are subject very clearly to the market price. The companies have reserves that they've held for a very long time. So whether there's really an effect of the UK being on its own without the EU for these companies, I don't really see much of an effect. If we go to the next slide. The other big sector of the top 20 for the UK is consumer staples. And what all of these companies have in common is that they're all global. They have huge brands that are known worldwide, and there's not really, I don't really see that much of an effect in terms of these already established brand names that are popular globally. That there's going to be that much of an effect from the UK's exit. If we go through these, you've got Unilever, which is mainly a food and beverage company. Reckitt Benckiser, also food and beverage, but household goods. Diageo is a beverage company, mainly alcohol. British American Tobacco and Imperial Brands. Both these companies are tobacco companies. Again, global companies in emerging markets. And then there's the healthcare companies, the pharmaceutical companies, GlaxoSmithKline, AstraZeneca, and Shire. Again, these are companies that have developed drugs over many, many years and established brands. Their main competition is from generic drugs coming in as drugs go off patent. So in terms of the actual effect of Brexit, there's really not much on these companies. If we go to the next group, 4 financials companies, HSBC, Barclays, both major global banks, and then Prudential, an insurance company. Really, these are, again, diversified companies all over the world, many, many markets, and not really beholden just to the UK market. Lloyds Bank, a little bit more local, and therefore maybe some issues if there's business issues related to Brexit where there's a slowdown in the UK. But in general, the biggest issue for all these companies that we've seen would have been the currency, and maybe if the currency keeps going down, there would be issues, but I don't think a lot of that hasn't already been priced in. The final group, the other, this is the last 3 of the top 20. Again, National Grid, that's the electricity grid for the UK. It has nothing to do with Europe. It's completely domestic. Carnival, again, it's another one of the, it's a cruise line, so it's another one of these international businesses with customers all over the world. Vodafone may be a little bit affected again because it's domestic, but it's a telecoms business, relatively defensive. So whether there's going to be a huge effect from Brexit, I don't see it. So although in general maybe there'll be effects on economic growth in terms of GDP for these top 20 companies, this is an issue you'll often see. There's a split between the economy and the stock market, and those are not the same thing. And the economy can be doing poorly when the stock market's taking off, and the stock market can be doing poorly and the economy's taking off. There's often a mismatch. So if we look at the stock market, especially at the top end for the large market cap, whether underlying problems in GDP in the UK itself will really have a massive effect on these very global companies. Is questionable in my view. The main thing again comes back to the currency. Does the currency keep falling? But again, if the currency falls, maybe these companies actually could benefit from that. So, given that they have foreign earnings. Okay, so that's the first topic. Brexit, maybe not that much of an effect on the listed companies. The next topic I want to look at are what I call the ultimate fundamentals. It's one of my favorite ways for either looking at country valuations relative or looking at sector valuations to give me some idea of where relative valuations lie for countries or sectors. And I think it's very much rooted in the base of the actual pure root value of the company. I'm going to get into why that is with an example starting very much at first principles. So we're going to look at the price to book. In this example I'm going to run through for you, I have 2 companies. Okay, one's called Company Grow. That's because it's going to be our company in the example that actually has some growth, and the other one's called Company No, which is a company that doesn't really do much and doesn't really have any growth at all. So a growth company and a no growth company. In this example, you probably know that the value of a company, the basic value, is the assets minus the debt or the liabilities equals the equity. So the equity is the value, the final value of the company. In this example, I'm going to assume no debt. So Company Grow and Company No, they both have a factory making XYZ product, and they have no debt. So the assets equals the equity. Okay. The other thing you want to see on this slide is that equity equals book value. Just so we know when we go through, we're talking about price to book, we're talking about the price or the market cap of the company to the book value, which is also equal to the equity. So book value and equity is the same thing. Okay, so we go to the next slide. Okay, so we're looking at a price to book. Let's say that the factory that Company Grow and Company No both have the same exact factory to make XYZ product. Right now, that factory, or the book value of equity, which is in the bottom of this equation, is worth 1,000 baht, let's say, for both companies. So if someone came to me and said, what would you buy either Company Grow or Company No, with no forward expectations, just like right today, looking at these 2 factories, what would you pay? I'd say I'd pay 1,000 because I can take the factory and go do whatever I want with it. And the factory right now is worth about 1,000 for both of these companies. So the price to book, the price that I'm willing to pay is 1,000, and the book value of the equity is 1,000. So the price to book is 1 times. Okay. So let's see what happens. We go to the next slide. So in this example, what happens is Company No, nothing happens. They have this factory worth 1,000 baht, and they don't really do anything with it. So it stays the same value. The price to book is 1 times. What's interesting is with Company Grow. So company grow, they actually take it out, they make XYZ product, and they have a huge amount of cash come in. So their assets go up by 1,000 baht. So they've actually had a really good year. Now the book value of their equity is 2,000. It's 2,000 baht because they've actually gone out and generated some cash with this underlying factory. If I've paid the price of 1,000 baht already to buy this factory, so what happens is the price to book, which is 1/2, drops temporarily to 0.5 times. So now what happens is suddenly company grow is actually looking pretty cheap. So we can go to the next slide. So what probably happens is if I was going to go and take this company now and I was going to go sell it to someone, now that the book value of equity has gone up to 2,000, I could probably go and sell it to that person because I've got my factory worth 1,000 and my cash that they generated of another 1,000 for a total value of 1,000 sitting on the book, no debt as we talked about. I could go and sell that to someone for 2,000, so the price to book would come back up to 1 times. So that's the natural process of what would happen. I'd have a cheap asset temporarily at 0.5 times price to book, and then I can go and sell that to someone else. Okay. So what's really happened there? So we talked about the price to book. The other element that I want to introduce here is return on equity. So what's really happened there is if we look at this next slide, is company grow has had 100% return on equity. It had 1,000 baht in equity or book value, and they generated another 1,000 from doing operations with the factory. So there's been an ROE of 100%. Company no has had an ROE of 0%. They haven't done anything. The factory just sat there and no one did anything with it. I'd still value that company at 1,000 baht and pay for that factory because I could go and probably do something better than company no's management. But company grow is actually interesting and sellable onto someone else because they're actually doing some serious returns. Because the return on equity, as we'll see later, of 100%. Fantastic, and can happen in early phase, rapidly growing companies. Now, what we see if we go to the next slide is that if you have a stronger ROE, you should actually probably have a higher price to book. Because what you're noticing is that so far we've had a price to book of 1 times for both company grow and company no. You might say, you know what? If company grow has had 100% return on equity, maybe they'll have 100% return on equity again, or 50% return on equity, let's say. So in our example, company is valued at 2,000 baht. That's the book value. Maybe they'll do another 1,000 next year. So we assume that their book value will grow to 3,000. If we were going to pay 1 times price to book for that, we'd obviously value the company at 3,000. We'd buy it for that much. But what if we're assuming that it's not just next year they're gonna make 1,000 baht extra? It's going to be 2 years, and 3 years, and 4 years out. They're going to keep generating that much, or they're going to generate even more. We should start looking ahead at what the cash flows are going to be, this extra value added to the book, and we want to pay more and more and more for that. So we think they're going to be successful. Maybe the price to book should go up to 2 times because we're assuming that the growth is going to be a lot higher. So this is why strong ROE we should look for a higher price to book if we have a stronger ROE. Okay. Now let's look at ROEs just on their own. This is the actual ROEs for the S&P 500 on a sector basis. So if you look at the first bar, the financial sector returns about 9%, or is expected to return 9%. Tech is expected to return 27%, so much more. But what we can see there is although the financials return is low and the tech return is high, we would expect, given what we talked about, we'd want to pay a higher price to book for the financials and a lower price to book for the financials and a higher price to book for the tech companies. So what we have to bring into it is just looking at ROEs alone, which some people do, or looking at price to book alone. Both of those things have to be put together. So we have to see how much are the returns first, which is the ROE, but then how much are we paying for these returns? So that's the next step. So this is where we put the two together. So this chart is this type of chart is one of my favorite charts for relative valuations, like I said at the beginning, of companies. So where this starts is if you look at on the x-axis, if you look at the 5%. So we're assuming that we got a company that returns 5%. Maybe I pay a price to book for that of 0.5 times. So the ROE is low, fine, but I'm also going to pay a low price for that. If you go to the next slide. As we move up on growth, and we're expecting, or up on returns, we're expecting this company is going to return 10%, maybe I pay 1 times price to book for that. I pay a little bit more for that higher return. Go to the next slide. Same thing again. If we're getting 15% returns, we'll pay 1.5 times for that. We'll pay a little bit more. As we move out to the right, and we're getting higher and higher returns, we would expect to pay more. Until we get to the next slide, which is our fair valuation line. So it makes sense that as higher returns come through, we're going to pay a little bit more, and the line should be upward sloping. So in general, if you go to the next slide there, in general, on the x-axis we've got ROE rising, and on the y-axis we've got price rising, and we'd expect that as we get farther and farther along the x-axis, that we're going to pay a higher and higher price. Okay, so what happens when we move off the line? What happens when assets, what this line assumes is that everything is fairly valued relative to other assets in the market, that we've got a reasonable valuation. What happens when we move off the line though, and we see an asset that is not going along with our fair value line? So if you look at the red dot in this diagram, this is at 20% returns. So what's interesting is that on our fair value line, 20% returns cost about 2 times price to book. But at the red dot, 20% returns are costing 3 times price to book. So we're paying way too much. We can go to get that blue dot asset, whatever asset that is, that returns that much at that price, we can go buy that instead. So actually, buying that red dot, we're probably overpaying, and we'd be better off buying this other asset. So if there's not a legitimate reason, maybe this year's returns are lower than people expect over the long run. So really returns are 40% or something like that long term, and this is a bad year. We need to make sure there's no specific reason that red dot has deviated from the line. So a lot of this valuation method is just looking for where things have moved off the line and then determining, is there a legitimate story for this? If there's not a legitimate story, then we want to look at either buying another asset other than that asset, or we do want to purchase it, and we're going to see it move back down to either move back down or back up to the fair value line. So if we go to the next slide. So everything along the corridor here of the blue line is relatively fair valued. So a little bit over the line, a little bit below the line, you're still within fair value territory. So maybe not a huge room for the asset to potentially move if it's a short-term problem or story. If we look up to the up and to the left, we see the red zone, where we've got a high price, but we've got a very low return. So generally we want to avoid assets there. The assets we want to buy are to the right and down in the green zone, where we've got a high return, but the price is actually really low. So that's where we want to focus. When we see assets down in this green zone, that's where they become interesting. Or generally below the line, but certainly in this high return, low price zone is we want to investigate, why is something sitting there? Maybe there's a story where it really is a high return company that's having some seriously bad operations currently. How long is that going to last? We have to check the story. Okay. So let's put this theory to the test of the actual data that's out there today. So what this does is it compares the return on equity for each one of these sectors in the S&P 500 in the US versus the actual forward price to book. So the price to book ratio for 2017 and the expected ROE. So this is data from 2 days ago. So what we're looking at evaluations right now. So this allows you to see, the first thing you can see from this chart is that actually our theory really holds. Most of the companies are relatively close to that fair valuation line. There's no big discrepancies away from the line. There are minor discrepancies on a sector basis. If you do this same exercise with individual companies, you'll tend to see bigger gaps with the line. But the sector itself, because it's an average of all the valuations, it tends to compress the deviation. Whereas if you have individual companies, they can have big swings away from the line. But an entire sector tends to not be too far away from the line. So one interesting thing we can see from this chart is that clearly financials and insurance right now in the US are, first of all, quite low returns in terms of expectations, but also below the line, especially insurance. And you'll see this is a theme across markets. Insurance, definitely one of the most undervalued sectors. There are some reasons for that, though, as we said. When you see these undervaluations, you have to think, are there reasons? One of the reasons is that yields are so low that insurance companies basically take in a bunch of premium income and then they have to go invest it because they have to make payouts much later, 30 years later from the time they take the money, and they have to make a payout for instance, an insurance company. So they need to make a yield on that money to make sure they can make their payouts in the future. So right now the yields are so low that it's difficult for insurance companies to make a sufficient yield to make to meet their future obligations. So there's actually a reason right now why the insurance sector is a little bit undervalued. If you move up the curve to around 20%, in returns, and we go straight up, we see there's materials, basically at the line, and industrials, which is slightly above the line. That's actually pretty interesting because what you're seeing is a move into industrials lately because people think that the Trump administration is going to generate a lot of just general overall boost in economic activity, which is going to be good for the industrial sector overall, and they're going to go after infrastructure. They're going to expand the oil and gas sector in the US rather than import so much, so that there's going to be a general boom in industrial activity, which is going to boost the industrial sector. So there's actually a reason, again, why is that a bit above the line? There's usually a story for these things. If we go farther up the scale on the returns, we get to 25%, and we can see below the line we have healthcare. Again, why is healthcare undervalued below the line right now? A couple of reasons. One is obviously, again, because of the Trump administration, he has said that he's going to go after pharmaceutical companies and possibly cut drug prices, which will obviously cut into their margins, reduce the value of the companies. So concerns about that, people have sold healthcare. Also, pharmaceutical companies and healthcare companies are considered defensive because even if an economy turns down, people need to take drugs if they have health issues, and they need medical services. So these things are defensive companies. Right now, everyone's moving into growth companies, cyclicals, industrials, and more interested in those higher growth industries. So something like healthcare, which is a little bit more smooth in terms of its growth, is not as interesting to investors. So you have those two factors. So again, why something's below the line? There's usually a story. So we go to the next slide. We can check out the same basic idea in Europe. So we've looked at the S&P, what's going on in the US. In Europe, In terms of energy, insurance, banks, and utilities, low returns, similar to the U.S. Banks and insurance, again, reasonably below the line. Insurance especially cheap again. If we go farther out in terms of returns, up to 20%, 25%, you'll notice that for Europe, actually, at the high return level, household, industrials, health, and food, those sectors are actually pretty close to the line. So what you're seeing in Europe, actually, at the high return end, is fair valuation. If you go down to lower returns, what are some things that are overvalued? Maybe the tech sector. That's mainly because there's a few companies, specific companies that are, the sector's a bit smaller, and a few companies are pushing the valuation up. So again, a bit of a story there. Our final region, if we look at Asia, again, you see insurance, banks, quite below the line. The insurance story is the same in Asia as it is everywhere else. The lack of yield. Again, like Europe, less of a deviation from the fair value line for most of these sectors. One of the sectors in Asia that is far above the line is health. This is an interesting story from a Thailand perspective, because actually the Thai hospitals are trading at a very high price to book, and they actually make a large percentage of the health sector in Asia actually comes from Thailand. There's not that much listed, so the high valuations of the Thai companies are actually affecting the entire position of this on the line. So again, you kind of got to look at the underlying story for why there's undervaluation or overvaluation versus the line, and a lot of the times the stories are justified. You have to take a longer term view. For instance, for insurance, which we've seen in each region, insurance is a little bit undervalued. What we'd expect is yields are starting to rise now. So that problem for insurance companies is probably going to go away over the next couple of years. And then when you've got something like Asia, in the US and Europe, you don't really have particularly high premium growth. In a region like Asia, you've got a nice story where there's high premium growth for insurance companies, especially in China, and there's also the yield story, so you could see maybe insurance move to the line or even above the line. So you want to look for stories like that where you can see the relative value shift either back up to the line, avoid sectors you think are going to come back down to the fair value line. So that should give you some. Anytime you want to look at individual companies in an industry, you can take all of those companies and do the same thing. You can plot the price to book versus the return on equity, and then add a trend line, which is pretty easy to do in any Excel program, and you can see where your company is in a given industry. And in later shows, I will be doing that on an industry basis, so we can have a good look, a closer look into the underlying return on equity versus price to book for the sectors that we looked at today. So this is kind of an introduction to this concept, and we'll go into more detail in later shows. And I recommend you watch this again so you get the fundamentals of how this process works and why do we use it. If you go to the next slide. So one question I get a lot is why use ROE and price to book? Why not use price to earnings, the PE ratio, which is a little bit more popular as a metric, price to earnings and EPS growth? Why not plot those two against each other? One thing that you'll see is EPS growth tends to be a lot more volatile and tends to be can be higher numbers. So when you try to plot these out, you can get EPS growth that can be 1,000% because of a really bad year last year, or a lot of negative numbers. Whereas ROE, you tend not to get those extreme ROEs. You can get ROEs of 100%, 200%, but you tend not to get those really high numbers that you can get in EPS growth. So it's easier to plot it. Also, because it's return on equity, the equity tends to move less also and be more stable than the earnings itself, which again can have these big volatile swings. Equity, as we've said, is kind of the value of everything in the company, and tends not to have swings of 100% or 1,000% or see crazy numbers in the underlying equity. Tends not to. Can happen, but not as much. Another question for this method is, what if everything is overvalued? What if the fair value line of the relative, going through the relative valuations is all right, but this entire group is overvalued and maybe they should be lower valued? That's definitely an issue you have to look at, and you have to think about. It's not just relative valuation, it's absolute valuation. Is the entire market overvalued? Because people are buying everything in that market, and although relative valuations look okay, maybe everything's on the line, maybe this sector itself is heavily overvalued. So you do have to take a step back and look at the absolute levels of valuation also. So that is all for today. We've covered the basics of the Brexit issue in relation to the large cap stocks in the UK, concluded that it's probably not going to be that much of an effect of Brexit on these large cap stocks. And we've also reviewed a method of relative valuation using price to book versus return on equity from the fundamental example of the basic the basics of a company and what is in the equity and how that grows, and then use that to look at the actual data currently for global sector valuations. Please come and join us next week. We'll be here again at 3:30 for more Global Talk. And that's all for today.